All right. Well, I'll stand right here in the shot. Thank y'all for having me. I got a full 180, even, 200-degree view here? No. It doesn't matter. I'll just keep turning around. Before I get into the content, I just wanted to say how proud and thankful I am to be just affiliated with you all and what all you're doing in the community, just to help those who are affected, of course, by the recent events, but just ongoing. You guys are champions of giving and making an impact to the least of these out there. So thank you all for everything you're doing. Really appreciate being a part of it. So David Brown, Sierra Pacific Mortgage. Our office is down here on Oakland, just down the street. 4 years we've been there. 4 years with the company, 2 years at our current location, 2.5 years. And so come by and see us sometime. I brought some cups. We just had these. We'd sponsored a soccer match at ETSU and have some leftovers from that.
At first I thought you said 40 years, and I went, how old are you?
Yeah.
4 years.
Well, it's funny you say that. Our company is still independently owned. We were founded in '86. The guy that founded our company, Jim Caffrini, still owns it and operates it today. You can count on one hand the number of companies that still have the same name that they did back in 1986. So pretty unique, I think. So I floated out to a couple of y'all some questions, some topics you might want to discuss, and then so we can kind of go through these, and then we can talk about some other things that are on your mind, some things you're seeing in the market. I always really, like I said, I'm more interested in hearing about what you all want to hear about and talk about than what I have to share. Because frankly, there's always changes in our industry. It's hard to kind of, a lot of them are very in the minutia, and so they're not very exciting until you kind of run into a situation. It's like, oh yeah, well now you can do this, or Freddie's now allowing this, where Fannie doesn't, or whatever. So there's just always change. That's a constant. It makes things interesting and lively in our business. So one question was, hey, pros and cons of 100% financing. And so I think that's a great question. I think that's a topic that most first-time home buyers want to know. Like, hey, what do you have as a first-time home buyer? When they say they're a first-time home buyer, what they're really implying is, how can I get in this house without any money down? It's and also interest rate's important too. They want to get a deal on that. And so, first of all, I thought we kind of go over what 100% products and programs are available, and then we can talk about the pros and cons of going that route. So my favorite loan product's the VA veterans. For veterans, it's 100% financing. You don't have to put finance 100%, but you can. The wonderful thing about VA is the interest rate is typically markedly better than what you can get on a conventional loan, and there's no PMI, so no private mortgage insurance required with VA. And so, depending on the size of the loan, that could be, pretty significant monthly savings, not having to pay PMI on a VA loan. USDA is a very popular 100% program. No money down. If I were to rank it, I'd probably rank that just behind VA. There is a funding fee, and there is with VA too, potentially in some cases. But the USDA funding fee is only 1%. So it's very low, gets rolled into the loan amount. And then the PMI on USDA is significantly cheaper most of the time than, definitely cheaper than FHA, but also most of the time cheaper than conventional PMI. So the PMI factor on USDA is 0.35%. FHA is 0.55, so it's almost half of what you would pay on FHA. So then we move down to THDA. THDA in Tennessee Housing Development Authority or Agency, which is a state bond program offering down payment assistance. And so the THDA, when you hear about a THDA loan, well, it's not really a THDA loan. It's more of a THDA down payment assistance program where you're getting a loan, whether it's an FHA loan, USDA, VA, or even conventional, and then you're layering on that a down payment assistant supplement. So it's either $5,000 or 5% of the loan amount. And so effectively, you're getting 100%, sometimes a little over 100%.
What determines 5,000 or 5%?
The borrower can choose. Yeah, so 5,000 most of the time is not going to be as much as 5%. The reason why they would choose that might be because they don't want to pay a monthly payment on that. If they choose the 5%, that's repaid monthly as part of their payment. So that's amortized over the same term, 30 years. And they may not need the full 5%. But it is a lien. It's not a grant. It's a lien that goes on the property when the property's sold or refinanced. That it does have to be paid off or paid back. So, but a great program for 100% financing. We now, when we first rolled out THDA, when our company did about a year and a half ago, it was just limited to FHA, but we recently had added USDA and VA. So you don't see many situations where people do that, but if they do need that extra help on closing costs and the seller's not paying them, then we can layer on that THDA on a VA or USDA. And then we have conventional coming. I think we're about to roll out Freddie Mac as well for THDA. So pair that 97% Freddie first-time home buyer with THDA for 100%. So what's a pro? I mean, obviously the pro is no money down, no money out of pocket. A lot of first-time home buyers just don't have the resources to put 3%, 5%, or 20% down. Makes it easier to get into that first house. These government loans are essentially government subsidized, which means you're getting a better interest rate. You're not putting much money down, so that's a good thing for a lot of people. I would say the cons, and y'all see this. I mean, this is nothing new to you all, but the cons would be, these loans often are not perceived as strong as a conventional buyer. It's unfortunate, and sometimes that's really not the case. But I think there's a perception among sellers that if you're coming with a USDA loan, you're not as qualified or you're not as strong, or it's maybe more likely to fall apart than that conventional 10% down, 20% down buyer.
What would have built that perspective? I mean, where would that have come from as far as?
Well, I think a lot of it just kind of is a personal thing of the seller or the listing agent who sees that and says, well, I've got someone who doesn't have any money to put into this, and therefore they're just not as strong financially as maybe that other client that's either cash or has a down payment. And then part of that could be, and we'll get into that too, about the appraisal requirements that a USDA appraisal or VA appraisal might have that are more restrictive than a conventional loan. But that could be a perception from the seller. It's not as strong. Does that make sense? Yeah.
You see a lot of people that, they'll say, well, I'm qualified for this, but my credit score wasn't high enough to go USDA or something
Yeah.
like that.
Yeah.
Is there ever like somebody that kind of qualifies for just about any of those, or is it always like you're going to be able to get one but not the other? Because it always seems like there's like a...
Man, that's a great question. There's so many nuances,
Yeah.
especially, so Dustin's essentially, hey Matt, he's asking, can borrowers usually qualify? If they qualify for one, does that necessarily mean they can qualify for these other loans? Like,
Pretty much, yes.
And no, because there's so many nuanced aspects of these loans, especially when you're talking about a borrower who's kind of marginal on the credit side. Let's say they got a 630 score, and a lot of companies might go down to say a 620 on FHA or even conventional. Well, a credit score is a requirement, but it's not necessarily a guarantee that they're going to have the risk profile to be eligible for that loan program. That's hard to explain to borrowers because there's other factors in the loan that come into play, like debt to income ratio, reserves they may need in the bank, what's in the credit report that's contributed to that score. So maybe they had a mortgage late pay in the last 12 months, that kicks them out of being eligible for an FHA loan. USDA has a generally USDA is at a 640 score, although there's what's called a low FICO band there between 620 and 640. But to be eligible for that, you've got to be able to check the boxes in some other ways too. So there's just different nuances to, yeah. So, and then conventional the same way. And so, anytime we get a loan application on the front end to do a pre-approval, we're gonna run it through the automated underwriting system that Fannie and Freddie have, or with USDA it's called GUS, Guaranteed Underwriting System. You run it through, and if it meets their risk profile, you either have an eligible loan or you get what's called a refer. A refer you can sometimes do, but it might mean they have to meet these other. So anyway, without getting too in the weeds with it. I think another con of 100% financing is, the buyer's got less skin in the game. You got a buyer that buys y'all probably had buyers who buy a house maybe with a USDA loan, and 6 months later they say, you know what, we don't like this house. We want to sell it. And it's like, well, if they financed in the upfront funding fee, and so they financed 101%, now they want to sell. Maybe the market hasn't, risen like they hoped it would, and there's realtor commissions and, other closing costs that come into play. So, had they put that 5 or 10% down, then they'd have maybe a little more flexibility to get out of that home. So that can tend to be a con. And then, like I said, the offer could just be less attractive to the seller. Matt, you had a question too about election year. Why is it weird for buyers and rates? It's a real thing. I think obviously, I think it's more of a perception thing than a reality. But people tend to have kind of a wait and see attitude around who's going to be in office. I think there's some merit to that in some ways. I think depending on who gets in office, it could be more favorable for business in some ways, and I think history shows a lot of times that there's not much of a difference. There's not that much of a difference in some ways. It probably depends on who you're talking to, what kind of business they're in, but there is definitely a wait and see kind of attitude. So I think we might see, y'all might have some buyers who've said the same thing. We want to wait and see how this election plays out. God, there's so many nuanced things to our economy though that you just, it's hard to say what's going to be the outcome. From an interest rate perspective, the Federal Reserve is supposedly an apolitical entity that's not influenced by politics. And I was listening to a podcast the other day about that and how darned if you do, darned if you don't kind of thing too from the Federal Reserve. Like if you don't lower rates, then you might be perceived as trying to influence things. If you do, you might also be perceived as trying to do things politically motivated. But there's always kind of that question: is the Federal Reserve, are they truly making decisions in the best interest of the economy, or is there pressure there? Because there is pressure. You hear it all the time from politicians, like, "Oh, the Feds need to lower rates. They need to stimulate the economy." So it's there. It's just and it's a good question. How much does that really influence their decision? Probably somewhat. When the Feds do lower or increase rates, I think it's important to remember too that it does not have a direct impact on mortgage rates. The mortgage rates kind of act in anticipation of what's going to happen in the markets, and so when there was chatter and almost certainty about the Feds lowering rates in September, you saw mortgage rates come down in advance of that. And then what's happened since the Feds lowered rates, they've done nothing but go up, pretty much. And so we've had some borrowers who said, well, we want to float our rate because they should just continue to go down, down, down. and unfortunately, that's kind of, gone the wrong direction for some buyers. So hindsight's always 20/20 with rates. I mean, the markets are so unpredictable, and it's hard to forecast it. Anyone who says they know what's going to happen with rates, they're full of it. They just are. I mean, I think there is still a general thought that over the next few months and year, rates will come down, but from a day-to-day, week-to-week, it's anyone's guess, I think. How closing costs vary. Any other questions about that? Or, I mean, we can talk more about that, but rates are fickle. Yeah. I wish I knew. I tell people when it comes time to lock, it's like, well, are you comfortable with this rate? If you are, let's go ahead and lock it in and put it to bed and not have to worry about it. So I tend to hedge on the side of let's just go ahead and get it locked, unless their contracts like 60 or 90 days out, then we might want to wait till we're a little closer. How closing costs vary, that's there's no real rule of thumb with closing costs. I think people, I always have agents like, hey, we're about to write this offer. How much should we ask for in closing costs? And like any answer, it depends. I mean, everyone's situation is different. Their loan program, the loan amount, the loan size, a general kind of guideline might be 3 to 5%, might be kind of the bulk, but that's a big range. I mean, you're talking about on a $300,000 deal, that's anywhere from what, 9 to, my math is off, public math, $15,000. Yeah, so that's kind of a big range. The biggest thing we see is that causes that number to fluctuate so much is the prevalence of discount points. So the cost of that interest rate, 3 years ago in 2021, 2020, when rates were low, and I mean, you didn't ever really need to price a loan with points. And then 2022, rates started going up really fast. The bond markets felt like the duration of these loans wasn't going to be very long because they thought the rates were going to come back down, and so it made rates more expensive, which created the prevalence of discount points in a big way. So for the last two plus years, it's been hard to price a loan at par, meaning no discount points at all. And that, not to get too far into that, but discount point. So one point would be 1% of your loan amount. So if it's a $300,000 loan, that'd be $3,000. But that's in addition to everything else. That's the title fees, the transfer taxes, the title insurance, everything. There was there are times where maybe, and then you have loan level price adjustments if they're credit or whatever. There might be more points. There might be 2 or 3 discount points on a loan, and those can really start to add up. So, if you have a conversation with a lender and you're saying, well, what's the closing cost in this loan with this buyer? What should we ask for? And it's a really big number. I bet you there's probably some discount points involved. If it just doesn't kind of make sense with the amount they're giving you. And that's a good question to ask. How much of that is discount points? What if they went with a higher interest rate? Could we get those down? And that's why it's important for clients to get an estimate, and not just hey, here's your cash to close, here's your payment. Let's kind of see a breakdown of this. It's like when you go to the car lot. They don't want to know. They don't want to tell you what the cost. They want to know, well, what monthly payment can you afford? And let's be a little more transparent with things. How taxes impact buying power? That was another question Matt had. I think you were referring to like income taxes. So, and I guess it's more so. I think you're probably wondering that about like with self-employed borrowers, more so. Yeah. If I'm working with a self-employed borrower, and self-employed is kind of a general term, so that could be like a contract employee, a 1099. That could be like a realtor. I mean, we're going to have tax returns, and that's how we're going to quantify income. I had a past client around the other day who's been in business. He's in the medical profession, but he's self-employed. He says, "Well, David, I pay myself this much every month." I was like, "Okay, that's great. But we have to look at the tax returns because he's a veteran. He's using a VA loan, and the VA is going to average the last 2 years. So he's saying, okay, well, as I'm doing my tax planning with my accountant, how do we show more income so that I can qualify for a bigger loan because he's wanting to buy a really expensive house. I was like, well, so we kind of back into it. I was like, well, with this loan amount, you're going to have a payment of this. You're going to have taxes and insurance of about this. You've got this other debt we have to account for. So VA will allow you to go about up to 50 or even higher % of your income. So you divide that, you're going to have to be making X amount per month. So have your accountant show that. Keep in mind, though, we're going to be averaging the 2 years. And so it may have to be even more than that to get to that number. So, and then with tax returns, we're under the way we're regulated. We're going to have to get tax transcripts too to make sure that what they file with the IRS is what they're giving to us. So there's really no way around that. The same business owner said, well, year to date, I've made X amount more than what I made last year. Can you take into account the trajectory of my income? I was like, unfortunately, no. A P&L can support what you've made, and an underwriter will want to see that. Like you're on pace to do at least as good as you did last year, but it's not going to be used to calculate their income. So when I did commercial banking for 7 years, there was a constant theme of you want your cake and you want to eat it too, kind of thing. Like you don't want to pay any income taxes, and yet you want to borrow a ton of money. It's like, well, it's great you're not paying taxes, but if you want to borrow a lot of money, you're going to have to show more income. So it's kind of hard to get both sides of that, right?
I was thinking that when you said you
but
were saying how can you show more income, but your CPA doesn't want you to do that.
Well, the CPA is signing that tax return. They're on the hook for an audit potentially, and their job, CPAs are trained to do one thing, and that is to minimize your tax burden. And they do, and a lot of them do a really good job of that. But a lot of times is at the expense of being able to qualify for more financing. So it's you can't have it all. So obviously, I don't know if that answers your question, Matt, but buying power is absolutely directly tied to what kind of income you can show. And so there is some planning. So, and I think that's a good point too, like working with a CPA, especially a self-employed borrower. I think having forward-looking conversations, not just reactive or retro a look at their taxes is valuable. Because it takes time to plan for those kinds of things. You can't just snap your fingers and show more income. And then lastly, many say that this won't pass VA or FHA, like in terms of like in a property condition. And so I guess the question is, what's like an absolute no-go for passing a VA or FHA inspection? I think the general thing to keep in mind is this going to affect the safety or soundness or security of the homeowner? And so I think anything related to that. So if there's like paint chips that a little kid could snort or eat, then that's probably going to be something that I want to hear it. Broken a broken window pane that could fall out and slice someone's arm off or something. Water intrusion that's going to cause mold. I don't. A lack of a handrail over a porch that a little old lady could fall over and break her hip.
I think the more pointed part of that question is that kind of stuff too. It essentially gets flagged, and then it's like this needs to be corrected, and then it can be corrected, and then it just goes through. And so I know sometimes like people are like, well, I don't want to entertain it because it'll fail it, and I'm like, the only time I think of if I'm like looking at something is if it's just such a rough house, like we go into it and there's exposed, there's holes in the wall that show like insulation,
Mm-hmm.
there's no floor,
Mm-hmm.
it's just painted subfloor, or it's just
Mm-hmm.
really
Mm-hmm.
crazy beat up. I'm like, oh, this is not going to go VA. Let's not even mess with it. I guess in theory, somebody could come in and dress it up before the appraisal,
Mm-hmm.
but just kind of what is something that's like, oh, this, the way that it is like, it's just a skull and crossbone for a government-backed loan, essentially.
Yeah.
Because, you know, I know because TPR valve, you know, things like that, having the extension on it, you can run through and knock that stuff out pretty quick.
Mm-hmm.
You'll have some agents that are like, oh, we won't do a VA because we need a handrail.
Mm-hmm.
We'll put a handrail on it.
Right.
We'll figure it out.
Yeah.
But they're like, oh, no, I just won't go VA.
Hmm.
So that's what I was kind of really wanting to spearhead of like, okay, what exactly is like, if it is this, or it has mold, or it's this, like, it's just not gonna fly.
Yeah. I'd love to pick the brain of a VA appraiser sometime, and maybe to bring in one to something like this would be helpful.
Yeah.
What about heat? Like, and because I had this question last night.
Yeah.
And this is perfect timing because it's John was asking me. He's like, you know, we were talking about doing some baseboard heating.
Oh, he had texted me about something related to that, I think. Yeah.
And it's like, what rooms have to have
Yeah.
heat inside them for them to be considered?
Yeah.
I was assuming it was livable spaces,
Yeah.
bedrooms, living room, or not kitchen, but bathroom. I didn't know about kitchen. I wouldn't assume, but maybe there should be.
You know, the way, and Danny is, y'all met him. He's been here a few times, and he's usually who I talk to about things like that. And yeah, panty button Danny. Yeah. He loves telling that story, which is pretty funny. You know, I would be interested in talking to a VA appraiser about that, but what I always hear from him is you've got to have a heat source that does not require human intervention, of course, so a fireplace isn't going to work. A kerosene heater is not going to work. Anything plugged in is not going to work. So if it's baseboard heat that's plugged in, no go.
That's what I was saying. It had to be
Yeah.
hardwired.
Hardwired, yeah.
It depends, like, how many rooms is that?
Right. So can the heat reach all the livable space and keep the home at what is it 55 degrees, something like that? I think it's 53, 55 degrees, something like that.
Something like that.
Yeah.
That's what you're supposed to recommend.
So if you can,
Pipes in general,
right.
so people not dying.
Yeah. So I mean, if you can convince an appraiser that it will, like I think I've seen gas logs be okay. Like as long as they can, you could reasonably say this they'll get heat to the parts of the house that need it. But you know, human intervention, you know, is a no-go. Something plugged in, generally no. That's kind of the litmus test, I think, to start with, and then can it reasonably reach all areas of the house, the living area, and keep it 55 degrees.
Put one on each end. Just
Let it roll. Yeah. 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 So that's all the questions I had. Was that your question you had about? Okay. Yeah. Yeah. I don't know. Maybe having a VA appraiser come sometime. Have y'all ever had one come to do something like this?
No, I don't think so. I think the only appraisers that we've had have come with you.
Okay. Yeah. Danny. Yeah. I mean. Yeah. And then I know too with VA, like you've got well water tests, and you know they want to know distance, the field lines from the well and the septic tank, you know, all that stuff too. So that's so. Any other questions? Any other hot questions for financing? Okay.